And then the big moment, guys. I am honored to introduce our amazing guest speaker, Anthony Pinto. And he's the founding member of the team Asia Pacific, guys. What an honor for me to introduce him. He has been actively and passively investing in real estate from the past 4 years, with a portfolio spanning from short-term rental to large apartment complexes, most of which he acquired during his 3.5 year in Japan. Oh my God, we can do this from Japan, guys. So we cannot have found a better speaker for this topic. So Anthony, thank you so much for being here with us. And we're eager to learn from your experience in the world of multifamily real estate investing. So thank you so much. And I will turn it over to you. I'm gonna stop sharing now so you can start sharing your slides.
Awesome. Well, I appreciate it, Ari. And yeah, let me bring up my slides here. All right, can y'all see my screen now?
It's thinking. It's showing that you start screen sharing. Just don't say it just yet.
Okay, cool. Let me know when you can see the
It is good
screen.
now.
Okay, all right, perfect. All right, well, thank you all for having me on here today. Yeah, this is this has been a big honor to be asked to be here. And you know, I was talking to Anne about coming to speak here today, and how nervous I was. I've talked about multifamily on like kind of an individual basis, one-on-one with people, but to talk to people, 27 different people on a Zoom like this is it's a little nerve-wracking, and to especially do it to an Asia Pacific crowd like this, it's it's a whole nother level. So I appreciate you guys letting me come on and talk to you about something I'm so passionate about, and especially to a bunch of military members who show such a similar passion as I do. And I just got to say before I get into this, I think from where we started with Asia Pacific, with a few people kind of coming on and talking about, I think it's kind of some random topics that we were first kind of getting into, to where it is now, and kind of seeing this transition and everything. I mean, I got to really give it to the crew and the founders and Anne and everybody for the work that you guys have put into all of this, and the marketing and the transitions, and the breakout rooms and all that. Like, well done with everything. I mean, it's amazing to see this, what this has grown into, over the I guess it's been almost a year and a half now since we got started doing this. So well done. I just wanted to say that.
Yeah, just a little over a year. And it's crazy because you say a little over a year, but at the same time, we only do this every other month. And when we do it, it's like a concentrated 2 weeks. So to see growth, to see how much we've matured as a team, and the products that we share with the community. Yeah. So thank you. It actually means a lot to me to get your kind of feedback stuff. So thank you.
Yeah, absolutely. Yeah. So I know that we only have, 30 minutes to kind of get into this, and I have quite a few slides and I can be pretty verbose. So I'm going to go ahead and jump into this. So, as we kind of talked about, in a lot of the marketing, and, as Ari mentioned, we're going to be talking about commercial real estate here today. And specifically, we're going to be talking a lot about multifamily specifically. But as we get into the kind of the intro slides, we're going to be touching a lot on like the basics of commercial real estate. But as we get into kind of the later slides, we'll talk a lot on multifamily and more of the basics on how to get into multifamily, how to source deals, and that sort of thing. But as you can see at the bottom here, some of the bigger thoughts on commercial real estate here are like multifamily buildings, large apartment complexes. And this is actually one of the buildings that I currently am a general partner on, called the Downtowner in Augusta, Georgia. I don't own this complex or this mobile home park. And then this is just an industrial building I found on the internet. But here's a kind of a spectrum of different commercial real estate options that are out there. So this is the agenda of what we're going to go over today. So we'll talk about, a wide spectrum of different commercial real estate options that are out there, because there's definitely more than just multifamily or large apartment complexes. We'll talk about the differences between residential and commercial real estate. One of the things that I found fascinating when I was listening to the breakout rooms is that seemed to be a lot of people that had, real estate experience already, whether it's just owning one residential property or doing Airbnbs, or even just getting, starting a master's degree program. Like, it's amazing, what people are being able to do, even from Japan or from Korea, or just living overseas in general. So that's awesome. So, I mean, there's still a lot of differences even between residential and commercial real estate, and I want to kind of highlight those. We'll get into the benefits of investing in commercial real estate, and specifically investing in multifamily. And then we'll talk about how to invest both actively and passively, because there's kind of benefits and disadvantages in both aspects of that. Then we'll get a little bit more into the nitty-gritty side of specifically sourcing and underwriting commercial real estate deals, mainly from the multifamily side. And then more into how to actually find and who do you need on your commercial real estate team. And then lastly, we'll get into books, podcasts, and any particular lessons that I specifically use to get myself started. So without further ado, this is not an all-inclusive list of different types of commercial real estate. If you look at lists of assets owned by like Blackstone or KKR or these private equity firms, you'll probably see 100 different types of commercial real estate options that are out there. But I kind of condensed this into 8 because it's probably a lot easier to look at and understand than 100 different items. But these are probably the 8 big ones that you're going to see, and then you can probably break them out from here. But multifamily is often the most sought after and most popular of the type of commercial real estate that's out there. It's easy to understand. It's easy to know how to evaluate these types of deals. It's easy to know, okay, and look at a property and know that it's a multifamily property, right? Within that, you're going to have, your really nice properties, like your nice apartment complexes that maybe go for $3,000-$4,000, that are brand new properties, that are newly developed properties. And on the other side of the spectrum, you're going to have your Class D properties, which may have heard the term war zone properties, that maybe were built 100 years ago, that maybe didn't have been updated once, that have your lower class of tenants that are living in them, where you maybe need to have a gun on you when you're walking around the property, right? So within that class, you have a kind of a wide spectrum of different classes there. Industrial, those are your warehouse types of properties. Those can also be logistics types of properties. That can be data centers. So even within industrial, you can have a wide spectrum of different types of properties. Industrial has actually been pretty hot lately for a lot of different reasons. Office, that has not been a hot property asset class lately, to the point where it's even hard to find lending on office properties. But office can be, your typical office space that you'll find in like New York City, where, like a lawyer firm or law firm could be working there. Or it could be like a suburban kind of flex office space where you'll find like a medical, facility being there, or, an office space that, a bank might be out of, or something along those lines. So, again, an office asset class could be a wide spectrum of different types of spaces. Hospitality, that could be anything from a motel to a luxury hotel, right? So again, a wide spectrum of different types of assets there, but hospitality generally is what I'm referring to there. Retail, malls, strip malls, a lot of different types of assets there, but retail is a generally one type of asset. Self-storage, pretty self-explanatory. Mobile home parks are actually pretty popular right now because they get a pretty bad rep, but no one's building them anymore. So they're pretty scarce right now. So you can get a pretty good deal if you're willing to tackle those types of properties. And then lastly, land. Land's a pretty good one to buy as well if you can buy at a good price and you're in the path of progress. But land, there's a number of different types of land you can buy. You can buy arable land for farmland. You can buy land for development purposes. You can buy land along waterways and buy the rights to those waterways. You can buy land for oil rights. I mean, there's a lot of different ways that you can buy land. And we can get more into like how to actually buy these different types of properties when we get into and how to source these deals. But if you're looking for like general lists, this is probably a good way to start. And then if you want to Google these individual types of commercial real estate, you can really dig down deep into those hundreds of different types down from there. All right, so let's dig down into like multifamily specifically, because I really want to focus on that because that's my kind of my bread and butter. So let's start with residential real estate. So if you have really any real estate background, you most likely started with residential real estate. And residential real estate is your single family homes, your small multifamily, 2 to 4 units, townhomes, condos, kind of your everyday houses if you grew up in a house like that, right? Your standalone house had a backyard, had a front yard, had a white picket fence. Kind of think the American dream, like everyone wants to live in a house by themselves, 3 bedrooms, 2 baths type of house. It's the most abundant type of housing across the country, in terms of individual housing across the country. And that's the most popular type of housing that you're going to see. And on the other side, specifically for a commercial or for a large multifamily, that's anything that's 5 residential units or higher, all the way up to, you'll see 600, 800 unit apartment complexes, and that's still considered to be large multifamily in commercial real estate. Now, those individual units are going to be less abundant, but they're more dense properties generally. And you'll find that these types of properties, like 5 units, 10 units, 12 units, is very much going to be dependent on the area of which you live. There might be zoning that disallows, a certain type, like 5 unit or 10 unit or 12 unit. And you may not be able to find any of those types, or you may not be able to recognize those types of units. And it's very dependent. Like, for example, Norfolk and like the Hampton Roads area had quite a few of the small multifamilies, but it was kind of harder to find these like in between like 5, 12, 10 or 5, 12, 20 unit types of buildings, because they had a lot of smaller multifamily, but it kind of went up to like 50 units in that small in between. There wasn't just a lot of those types of units in the Hampton Roads area, at least that I saw. So you find a lot more people renting in that stage versus owning in that stage. So that's kind of the big differences between residential real estate and specifically large multifamily commercial real estate. All right, pros and cons between the two. So, now that you kind of understand and can recognize the difference between, physically the difference between these two, let's kind of break down the pros and cons of each. So with residential real estate, you're going to obviously need less money to get in, right? To make the math easy, you may own for $100,000 house, you put 20% down, you only need $20,000 to buy that house, right? If you're buying it for an investment property. Obviously not as, not a lot of money, relatively not a lot of money to get in. The barrier to entry is a lot lower. We only need $20,000. And it's also a lot easier to manage one individual property versus, 100 unit multifamily property in terms of the actual management of that property. Also, when you're dealing with $100,000 property, there's a lot more strategies that you can do with that property if you can't find a tenant for it, right? You can do a flip for it. You can do turnkey. You can do long-term rentals. You can do short-term rentals. You can just live in it yourself. You can do a house hack with it, right? There's a lot of different things you can do with that individual property. You can end up selling it if something goes wrong and you need to sell it for some reason, right? So there's a lot of different things you can do with it. And typically the type of person who rents a single family home or even a smaller multifamily, tends to be a better quality tenant. Not always, but they tend to be a better quality tenant, that at least I've found in my experience. And data tends to back that up as well. Now, on the con side of things, it's also a lower barrier to entry. So you're also competing with a lot of other people for these same types of properties, right? When you only have to bring $20,000 to the table to buy this property, you're competing with other people who also have $20,000 to buy that property. And now those multiple strategies also can work against you as well, right? Where you're competing against flippers, you're competing against people who want to buy this property for a short-term rental, for a long-term rental, for turnkey properties, right? So you tend to have a lot more competition, especially when it's a seller's market. You have a higher vacancy risk, right? So for a single family property, for example, you have one vacancy go, or you have that property go vacant, you have 100% vacancy with that property. Versus a 100-unit property, you have one vacancy and you have 99% occupancy still, right? You only have 1% vacancy, and you still have rent coming in from the other 99 tenants there, right? You have comps to evaluate the value of the property. So what do I mean by that, right? So let's say that you buy this $100,000 house, you put in $200,000 and make, this property be the next thing since the best thing since sliced bread, right? You put gold fixtures everywhere, you put red carpets, everywhere, and the person who wants to rent this house feels like a celebrity. Well, it doesn't really matter if you put $200,000 into the house is still going to be a 3-2 and evaluated against other 3-2s in the neighborhood when you go to refi the house or you go to sell the house, right? So that's kind of the bad thing about residential properties in general, is you're evaluating against comps in the area, and no matter how much you actually do to renovate the property. And there's some things that you could do to increase the value in comparison to other properties, but generally when you're comparing it to commercial property, which we'll get into, it's harder to increase the value based off of what you actually do in terms of renovations to increase the value there. Property management fees tend to be a lot higher depending on the area in which you live. Could be 8 to 10% versus commercial properties where you're looking at like 3 to 5%. And that's going to vary also, but you're looking at a lot higher fees there. And you're also personally guaranteeing loans. I don't know if a lot of people really understand that fact, but if you default on a particular property, like $100,000, I guess $80,000 loan, you are personally guaranteeing or personally liable for that loan, right? Versus a commercial property where the property, you're actually putting a non-recourse loan on that property. So you're not actually personally guaranteeing the loan, in the sense that the property is the property or the income that the property is generating or the value of the property is the only thing that the lender can go after, right? So if the property is worth $4 million and the property value goes down to $3.5 million, the property is the only thing that the lender can go after if you end up defaulting on it, right? And assuming that there's no bad actor or anything that you did wrong to cause the default in the first place, right? Versus you've personally guaranteed a loan, you have a recourse loan on a residential property and you end up defaulting on that, and the property goes from $80,000 to $50,000, they can actually go after your other personal assets to recoup the total loss on that property. So it may not seem like it's necessarily a bad thing, but a recourse loan that's kind of a lot of risk, especially if you have multiple loans with all these residential properties you're buying. But so let's get to the pros of commercial real estate. So there's forced appreciation, and I'll get into this on the benefits side of it a little bit more. But I can actually put in a bunch of money into a property and actually directly increase the value of that property by doing a lot of renovations and increasing rents on that particular property. And I'll get into that when we do a case study right after this. The value of the property is directly dictated by the income that the property is produced. And this is true across all commercial real estate. So for example, if I increase the property or the income or decrease the expenses of a property and have the NOI, which is net operating income, go from 100,000 to 200,000, I have directly increased the value of that property by not exactly 2x, which we'll get into later, but I've directly increased the income or the value of that property by the income that I produced for that property versus the comps for residential. And it doesn't matter the property next to me is floundering or if the property next to me is doing amazing. It only matters what the income that my property is producing. There's a larger barrier to entry, which means less competition compared to residential property. When you're dealing with $1 million, $2 million, $5 million price tag, there's a lot less people that you're competing against, but you also need $1 million, $2 million, $5 million to get in. Like I said, dealing with lower property management fees, lower vacancy risk. There's huge tax benefits, which I'll get into on the benefit side. Like I said, no non-recourse loans. And then you also have the ability to use other people's money. Now, this is also true for residential properties, but you're also potentially having to give up a larger piece of the pie when you're dealing with having to raise capital for residential properties. So, if you're having to raise $20,000 for a residential property, and you're probably only making, $500, let's call it, per month on a property that you're renting out, and you're having to give up half of that for, your $20,000 to a capital partner, may not be a really great deal, may not be cash flowing as much as you think you'd be making. So versus when you can raise $1 million from capital partners and you're getting a 70-30 split, and it may make a lot more sense because you can still make 10 to 12% a year on that property. So when you're dealing with commercial properties, you can use other people's money and still make a great return, and they can still make a great return as well. And when we get into the case study, I can, and show you a great example of how that worked out. So on the con side, like I said, it takes a lot more money to get started. There's a lot more maintenance that typically is involved with this, which is actually, in my opinion, a pro. It's actually a great way that you can find these properties for really great prices when there's a lot of deferred maintenance that goes into it. When you find roofs that need to be replaced, ACs that need to be replaced, parking lots that just destroyed. So that's actually a pro in my example, in my opinion. Sorry, but there's typically, you're dealing with hundreds of thousands of dollars of maintenance when you're dealing with a 100-unit multifamily property versus maybe a few $1,000s when you're dealing with a $100,000 residential property. Multifamily properties, depending on, if you're dealing with a really high class, 2023 brand new property versus, a lower class, maybe 1980s type of multifamily property, you're typically dealing with a lower quality of tenant. Tenants that typically have to rent apartment buildings are just not as higher quality of tenants. So you got to kind of weigh that in the fact that, you're going to probably have a lot of tenant turnover, and that tenant turnover tends to be pretty expensive as well. So when you're dealing with maybe getting $800 per month in rent, and your turnover costs maybe, $1,500, kind of gets pretty expensive. So you got to kind of do the math on, do you want to keep this tenant or do you want to turn them over? Because it's going to cost you maybe 2 months rent to actually turn them over. Commercial loans are actually pretty hard to find. There's not a lot of, there are a lot of lenders out there, but there's not necessarily a lot of lenders that are going to lend at rates that actually make sense, especially nowadays with the way the interest rates are. Locations are not as abundant as you would find with residential. That's actually pretty key. You got to find a location that makes sense and a location that has a population that's growing with job diversity or jobs diversity that actually makes sense with job population or job growth that actually makes sense, and a lot of different metrics that go into it. But unless you're actually developing properties, location really does matter for multifamily and really commercial real estate in general. They're just not as abundant as you would find with residential. And then management is absolutely key when it comes to commercial real estate, and it can absolutely break your property, which we can get into that if you want, because I'm dealing with that on one of my properties now. But they can absolutely make or break your property, versus residential, where you can definitely self-manage that. And it can go well or it cannot go well, but you really do need a third-party management with commercial real estate, particularly with multifamily. And if you don't pick the right one, they could totally mess up your business plan. And you can look at a business plan that's supposed to take you, 2 years to complete renovations on, property that could end up taking 3, 4, 5 years or never can be complete. So yeah, I'll just leave it at that. We can get into it more if you want, but all right, so let's get into a case study. So Marina Point Apartments in Chesapeake. This is a 104-unit property that was actually my very first property that we bought in March of 2020. Literally, we closed on this a week before lenders started shutting down all lending during COVID. This is for anyone who has ever lived in Hampton Roads. This is on the Portsmouth side of Chesapeake. And this is the Elizabeth River here right behind us, or right behind the property. So some quick stats on it. Like I said, 104 units, built in 1965. So it's Class C property, or it's just kind of based on the quality of it, Class C. A lot of the units were not renovated, so they're original, I guess, quality. So a lot of Formica in there, a lot of original wood cabinets, a lot of original laminate tiling, old tiles you can see there in the bottom in the bathroom. Very outdated, to say the least. Pretty good pricing per unit there. We were projecting a 12% cash and cash return. Physical occupancy is okay. We ended up putting about 550,000 into this property. That included 44 units, pretty much top to bottom, renovated. Some of them had to be gutted, some of them not. We redid 8 of the 12 roofs. We put in a dog park. We had to redo some of the dock. We did a number of things. And then the original plan was actually to refi at year 3 and then sell it at year 5 or after. What we actually ended up doing was selling it at the 22-month point. So we sold this in what would have been January of 2022. So we bought it for 9.25 and ended up selling it for 14.15. And you can say the projected annual average return was originally supposed to be 17%, ended up being 47.5% or 0.4%. Projected IRR was 14.8, ended up being 44.8%. And the total ROI, so that included all the cash flow for those 2 years, and then the profits on the back end ended up being 87% total profits on that. So pretty good return for 2 years time. And for, the budget that we ended up putting in was pretty good. So this was a pretty good home run, I would say, for first property that we end up doing. And the tenants were really happy. We did a really good job. I feel I'll toot my own horn on this one. I think we did a pretty good job on the internal renovations for the property, and making a pretty good quality product for the tenants. And there was still, and I think the key thing on this is there was still a lot of meat on the bones for the incoming buyers as well. And we pretty much sold it right at the top of the market as well. So very first property that we ended up doing. So benefits of investing in commercial real estate, and specifically, I think this is true for multifamily, in my opinion. So tax-free cash flow. So why did I put an asterisk on tax-free? So if you're going to get a 10%, 10% return on your investment, and you put in $50,000, you're getting a $5,000 a month, or sorry, a year. And that's, for as long as you hold the property, essentially. So that $5,000 you're getting a year is essentially tax-free. And why is that? Because you're getting depreciation on that property for as long as you hold the property as well. So why you don't see this in residential, and you probably see this for just a small extent when you actually depreciate your property by 27.5 years, split out. But it's pretty expensive to do what's called a cost segregation analysis. You typically spend, $10,000 to $15,000 on an individual property to do it. But you pretty much, what happens is you have an engineer come in and evaluate individual things like countertops, flooring, doors, individual appliances, and things like that. And they accelerate the depreciation on your individual property to the point where you can take, a $9 million, or let's call it a $10 million property for easy math, and put, maybe 20 to 30% of that depreciation within the first year. So when you take your $5,000 and you can pretty much have that written off as tax-free cash flow for as long as you own that property. So that's what I mean by tax-free cash flow. And on the back end, you end up having depreciation recapture. So it ends up the IRS ends up getting their money on the back end. But for as long as you hold that property, and if you end up rolling that money over into another syndication or another property, you can keep rolling that into, perpetuity, or you do a 1031 exchange. But for as long as you hold that property, you're essentially getting tax-free cash flow written off by depreciation. Second point there is forced depreciation. So like I said, what we took was $550,000 and did a bunch of renovations, and some of these units were the one bedrooms were at $825 to start with, unrenovated units, and we got them up to $1,025, so $200 increase. And the same things we did to 2-bedroom and the 3 bedrooms, and each of those, the 2 bedrooms are on average were about $125 per month increase. And the 3 bedrooms, these were the biggest, were $300 a month increases. And not all of them were renovated, but that was the average that we got. And those directly increase the value of the property as well. And when I show you the equations here in a couple slides, you'll see how that directly increased it. But that's the forced appreciation that we did versus a natural appreciation where you see, $100,000 property at, a natural 3%, appreciation that everyone talks about. So in, 10 years, it's going to be, $150,000. I don't know what that math would be, but you assume it's going to be worth more than it currently is due to natural appreciation, right? Versus forced appreciation, we did renovations, we increased the rent by X amount, $100, $200, $300, and we directly increased the rent or directly increased the value a certain percentage. And we went from 9.25 million to 14.15 million in 2 years time, right? And ended up selling the property. Third point there, pretty useful to use in a syndication, is using other people's money, right? And you end up putting your own money as a general partner as well, anywhere from 5, 10, 15% of the capital required. But it's super useful to be able to raise capital for these syndications to buy commercial real estate, right? And I think that's one of the reasons why I got into commercial real estate and multifamily in the first place is, I was buying these small multifamilies and single family homes, and I was using my own capital. I was like, man, this is going to take forever for me to get to the point where I'm going to be financially free if I'm only using my own capital. It's like, well, like, what if I just get into large multifamily and, bring in friends and family and classmates and whoever else and just raise capital this way. And so, lo and behold, it ended up working and making a lot of money along the way. But it's a really great way to invest in commercial real estate and make a lot of money, and making your investors a lot of money along the way as well. Number 4 there is partnering with experienced operators. I think this has been really key for my own personal growth, but also to learn a lot along the way as well. And I wouldn't have gotten to where I am now if I didn't partner with a mentor of mine who brought me into capital raise on that very first deal. And that's honestly one of the biggest things that I did for that, for Marina Point, was capital raising. And I ended up doing about $800,000 personally raised for that one. And I was in Japan actually by that time, because I got to Japan in December of 2019. And so that was the biggest thing I did with that was capital raising. And I did some minor asset management stuff as well. But I was able to partner with a more experienced operator who did a lot of the acquisition side of things, who did a lot of finding the contractors. He did a good amount of capital raising as well. But he did a lot of finding the property manager. I think he even lived on the property, like in a unit for a while, to manage the business plan and the contractors and all that for a while. But I think this is super important because I think on the residential side, like, you buy a single family home, you turn it into a short-term rental, a long-term rental, something else. But it seems to be a very like kind of singular focus, kind of a solo venture in a lot of ways, because you can do a lot of the things on your own, maybe watch some YouTube videos, join a mastermind. But on commercial real estate, like, it very much is a team sport. And if you're going to be raising capital, if you're going to be getting into acquisitions, you're going to be doing asset management, and you're trying to do it on your own as a newbie, like, you're kind of heading for disaster. So you almost need to be partnering with experienced operators, whether that's someone who has, 100 units under their belt or 10,000 units under their belt, who can show you a lot of the pitfalls that they've fallen into, or connect you with people who are in that particular market or in that particular asset class, or who can help you really get started on the right path. And I think that's really important, because once you really get one deal under your belt, man, the sky's the limit. I mean, in March, we closed on that one deal in March of 2020, and we had two other 100-unit plus deals done in that same year. And then 2 years later, we had another 100-unit deal done right after that. So, it just really had to get that first foot in the door, and then kind of took off from there. And the last point there is there's numerous ways to make money, and that's both on the general partner side and on the limited partner side. And you can do capital raising, which gets you a pretty good chunk of money. You can do asset management side, you can do due diligence, you can be boots on the ground. You can actually find the deal. You can, there's a lot of an acquisition side. You can look at the finances and like do leasing up. You can work directly with property management. There's a ton that you can directly do on the commercial real estate side. If you like one particular side of it, right, you can do marketing. Like there's a ton that you can do on the commercial real estate side. If you don't like capital raising, or you don't like asset management or acquisitions, or whatever else you don't particularly like, there's something you can probably fit yourself into. All right, so let's get into what a syndication is and like how to be more passive or active specifically. So a syndication is essentially pulling a number of individuals' capital together, and then buying a particular asset. So in this example of Marina Point, we raised $2.5 million to purchase Marina Point, and we obviously got a loan for it. And so we pulled both general partners capital, which I was a part of, and limited partners capital, which we end up having, I think, about 40 individual limited partners that we brought together into this syndication, which was just a company, an LLC that we formed in Virginia. And then that LLC then bought Marina Point Apartments. And so this is actually a property in Lubbock, Texas, but I like the building, so I put it on here. And then, so I just kind of wanted to have this flow of how everything goes here. So on the active side, as a general partner, there's a lot that you can do to actually get involved. And I guess the main way you get involved is through sweat equity. But you also do put some capital in to have skin in the game. And you can put that in through through actually investing as a limited partner, which some people do, but you can also put it in through risk capital. And that risk capital is used for due diligence. It's used actually as an EMD, because there's still EMDs that you have to put down just as you do in residential real estate. And whether that's actually non-refundable or not is kind of up to you and the seller and the broker that you're working with. So is it really at risk or not? That's kind of up to you and the broker you're working with. But you do typically put skin in or capital in. On the acquisition side, like I said, there's deal finding, there's working and trying to find a lender, there's due diligence. You are actually loan guaranteeing technically, which is called being a key principal. And you actually do get a pretty good chunk of equity for that. But you're pretty much just being, you're just putting your net worth up, if you will, not necessarily actually signing as a recourse loan in this case. And that's typically just for multifamily. You don't typically find that industrial or in self-storage or any other type of commercial real estate outside of multifamily. Let me be clear on that. Like I said, asset management, there's a lot you can do there, and then capital raising. On a limited partner side, which is passive investing, you're providing a majority of the capital required for the acquisition. There's also you're limited on the legal liability on the end of the downside. So if something goes wrong, you end up defaulting, you're absolutely not at risk. You may end up losing your capital if the property is sold or you end up foreclosing or sold at a loss. So for example, if you buy the property for $9 million and you put in $2.5 million, and so your debt ends up being actually, nope, I'm not going to do quick math on that. Let's just say you end up selling the property for less than it's worth, and you end up losing all your capital as a limited partner. That's really the big risk you have there. Or if your general partners end up being bad actors and they steal your money somehow, which actually happens surprisingly a lot more than you would imagine. There's actually a big general partner out of Texas. I can't remember exactly where. I think they were a big partner in Dallas that ended up having like a 3,000 unit portfolio that it ended up absconding to out of the country because they ended up stealing all their capital, and it's like a big Ponzi scheme. So that's kind of your big risk there. You really have to know who you're investing with. But outside of that, you're essentially just investing with the general partners that you really have to know and trust, and then ensuring that their business plan is being followed through. And then you're just sitting back and making mailbox money at that point until an exit event happens, and they either sell the property or they refinance. So you have to really understand that you're giving up a lot of control when you're going to be a limited partner, and understand who you're working with, and understand that do you trust them to first of all, make a good business plan and follow through with the business plan. Because, plans change, and the business plan that they present you on January 1st, 2023 may not be the same business plan that, is being followed through on December 31st, 2023, right? A whole year later. So you just got to understand who you're working with, and understand that things change, and there's a lot more that goes into it. And I can give you some books later on I think you should read if you're interested in being a limited partner. Yeah, sorry. All right, so let's real quick get into sourcing and underwriting, because I think I'm talking really slow here. So sourcing deals. So there's two ways you can go about it. There's on market and off market. So the best way to do both is to go to commercial real estate brokers. And when I say go to commercial real estate brokers, go specifically to the type of broker that is dealing with your specific asset class. There's specific commercial real estate brokers for land deals, for multifamily, for industrial, for retail. They are very asset class specific, and they're very specific to the particular market as well. So best ways to go about finding a commercial real estate broker is to look on the internet for those particular type of brokers. So you can go to LoopNet, you can go to Crexi, you can go to 10X Auction, you can go to CoStar even, and look up those particular brokers who are selling those particular properties, right? If you are from that particular market, and commercial or multifamily investors in that area, you can talk to those individuals and see, like, okay, what are the big brokers in this particular area? Because the old adage is very true that 10% of the brokers do 90% of the deals, and that is very true. So if you can find the top 5 brokers in your market that you want to invest in, you're going to be golden. But you have to be a viable buyer, because if you end up wasting these people's time, you're going to get blacklisted. So these guys who are these and girls who are these brokers deal with a lot of people who are just kicking tires. So if you're going to get on their list, you have to actually look like actually be a viable buyer for them. So that's my advice there. If you're going to go off market and go direct to owners, good luck with that, because a lot of people who own these commercial real estate properties, specifically multifamily, are hiding behind LLCs. And so if you can try going that way, and you can try using CoStar, which is expensive. You can try using Reonomy, which is also expensive, and also specifically to locations. But you're going to have to pierce the corporate veil and try to find individuals to actually contact you. And you may not even be able to, even if you do find contact information, good luck trying to actually get someone on the phone at that point. So I think your best bet is probably to go to commercial real estate brokers and be an actual viable buyer at that point. All right, we can talk more about that if you want on sourcing deals, but let's get into actually underwriting deals. So here's the math part of it. All right, so this is going to be relevant across all commercial real estate, not just multifamily. So the value of a property or the purchase price is equal to the net operating income divided by the cap rate. The cap rate is a pretty arbitrary number, and it's dependent on the asset class, location, and relative risk of the property being purchased. And if you don't know what cap rate is in your particular area, you can ask a commercial real estate broker for more details. You can look at a lot of different deals. You can look, actually, there's reports that you can look at for cap rates for different asset classes in particular areas. So you can look at Kansas City, for example. You can look at the multifamily cap rate for actually trending for particular quarters in the past. So you can look at Q2 2023 and you see it's 5% for multifamily in Kansas City in Q1 and so on and so forth. You can see what is trending. You want more specific details because it may even depend not just on Kansas City, it may even depend on a specific neighborhood in Kansas City or a specific geographic location. You can get as detailed as you want on that, but just understand it's a pretty arbitrary number. So it may not matter as much as you think it is, especially with how hot everything is. But generally, just understanding this equation is probably as much as you need to know for basics right now. How you get the net operating income is taking your total gross income minus your total operating expenses. And understand that your total operating expenses does not include your debt service. So this is assuming that you don't have any lending on top of this, like any debt service. And then another way to actually find your net operating income is taking your total income times your operating expense ratio, which if you're giving really low expenses, you're getting like an operating expense ratio of like 0.2, 0.3, because your seller thinks that they're running a really tight ship. Just go with 50% or 0.5 when you're calculating your net operating income. So for a quick example, let's take a 100-unit Class A minus apartment complex in Dallas-Fort Worth for sale. Purchase price is $6 million. Total gross income is $500,000. Total operating expenses is $280,000. And the cap rate is 5%. So we do some quick math there. Your NOI is $220,000. Cap rate 5%. Gets you a total purchase price or value of $4.4 million. So pretty big, excuse me, pretty big discrepancy between your purchase price there. So in my opinion, not worth $6 million. I'd probably pass on that, right? But this is a pretty quick back of the napkin, 10-minute, 5-minute even way to evaluate looking at these deals to see if it's even worth your time to do even a deeper dive on the T12 and go into deeper analysis on this. So these are very basic equations to use. If you want to go even more in depth on underwriting deals, there's a ton of different underwriting like Excel sheets that you can use and underwriting and analyzers that are out there. If you want my opinions on them, on which ones you use, I can definitely talk to you more about them. But for now, these are kind of very basic equations that you can use to evaluate, but depending on what numbers you have and what information. All right, so who do you need in your team? And I think these are the last couple slides I have, and we can get into questions. All right, number one person you need is a quality property manager. Like I said, they can absolutely make or break the business plan and your property. On one property on Marina Point, we had one property manager, and they were stellar. And they made the property go exceedingly well. They did the project management for the property. They got tenants in and out, and it went really well. I think part of that was probably having a general partner that lived on the property, but it went really well. Another property that we've had 3 property managers in there, and it has been abysmal. And the property is not going anywhere. It's actually gone down in value since we bought it. And a lot of it has been property management, just not being present at all on it. So it absolutely matters who you find for your property management on this. And we can get into more details on how do you find a property manager, how you vet them and all of that. But it really does make a huge difference on finding the right property manager for your particular property. Lender is a big one as well. You can go with, a huge, national lender if you want. You can go with a smaller local lender. You can go with, private lending. You can go with, there's a ton of different options out there. It really just depends on who you're comfortable with. If you want to get a great rate, if you want to get great options like no interest or interest only loan or interest only option for like 2-3 years, something like that, right? It really just depends on your personal relationship with the lender and what kind of terms you can get from that particular lender. But there's not really a wrong answer on who you use for your lender. It's just kind of up to you. But having a lender on your team before you go into buying the property is really the right answer. Having a reliable construction crew and contractors. If you're doing any renovations or flips or anything like that now, you're probably know that it's really hard to find reliable people right now for a good price, and getting things done on a timely basis. And that's absolutely true when you're trying to do a big job that costs like hundreds of thousands of dollars on a large multifamily property. So just understand, if you're going to get someone in there, it's probably going to cost a lot of time. You're probably going to have a lot of overruns. So build that in when you're initially raising capital as well. Have a lot of reserves on hand as well, because you're going to end up overrunning on costs in that. But having a number of contractors ready to go, so that there's not a lot of gaps in your timing for that is going to be important. Having a real estate attorney on hand, both to review your documents in order from you, like PSAs, purchase and sales agreements, LOIs, and all of that. But also when you start doing evictions, which you're inevitably going to end up doing evictions, is going to be important. Having a good property inspector, yep, that's common sense. Having an insurance adjuster that knows your property and can actually understand what they're buying for you is super important. We had a huge insurance issue on one of our properties, and we just didn't buy the right insurance, and it was a huge headache. Having a general partner boots on the ground, it can be important. I think if you don't have a general partner boots on the ground, you need to go to the property at least probably quarterly, just to understand what's going on, get a lay of the land, make sure the property management company is actually doing what they're saying they're doing. And then lastly, not really on your team, but understanding, and working with the city officials. It may not be as important as you think it is, but when the city officials are actively working against you, it is very, very difficult to get things done. Zoning issues start popping up, code issues start popping up. Getting simple things done like moving trash cans become almost impossible things to do. So work with your city officials, try to understand where the path of progress is, try to understand what they're doing and wanting to do in that particular area. If you can work hand in hand with them to try to improve that particular area, improve the property for the better, improve tenants' lives and quality of life, it will ultimately work in your favor. All right, and the last thing is additional resources. So these first two books are like the Bibles for me and when I was getting started. So Financial Freedom with Real Estate by Michael Blanc, hands down one of the best books that I used to get started. And I actually used him in his I bought his course, an online course, and I actually used his underwriter analyzer as well. And then Joe Fairless, he has a daily podcast as well, but he also wrote a apartment syndication book. It is very thick. It is very very wordy, but it's very good as well. It is pretty much everything you're going to need to know about apartment syndications and multifamily in general. And then this last one, the hands-off investor, it is very good for, passive investors. So if you want to know everything to know about passive investing, how to evaluate your potential general partners, questions to ask, things like that, that's a good book to know. And then lastly, podcasts. Rock Lee's a really big multifamily investor. He has a lot of in-person events as well, all over the place, if you're interested in going. John Kasman, really great dude, had him on my podcast. Dan Hanford, again, he has a lot of really great episodes and in-person events as well. I actually have my own podcast. Actually, it's been almost a year actually since I put that on hiatus because of babies, but that's still out there though, past episodes. And then the last one is Jake and Gino's podcast, which they also have a lot of in-person events and masterminds and stuff like that. But that's books and podcasts, and that's it. Any questions, anything else I need to add, Anne, before we get into stuff, or just start reading questions?
Yes, we do have a couple questions in the chat, and I will give you the option, Anthony, to keep your slides up or going back to the main presentation. Is up to you. What would you like to do?
Let's go ahead and go to our slides just because it has his contact info that people can get.
Perfect. Okay. So let me quickly share. If you guys want to start, so what next we're going to do, I'm gonna bring the slide up now, but we're gonna move into our Q&A. Please use raise your hand, and we're gonna call your name, and your be up to share your question. And if you cannot turn on your video on, or or you cannot unmute yourself, feel free to write your questions in the chat, and then we would read them. Okay, so and I know if you want to start reading some of the questions we have, if we don't have anyone raising the hand right now, while I'll start sharing.
Yeah, so I know in one of the chats, one of the big questions for you, Anthony, is how did you start networking to find a group to get plugged into?
Great question. So there's my, yeah, I'm still unmuted. So let's see, how did I get started? I think I just researched. How did I get started in this? So I originally got started in November of 2019 when I got off my first sea tour. And that's where I started getting to like large or small multifamily, and of house hacking a quad in Portsmouth, Virginia. And around that time, I met a mentor of mine who ended up bringing me in on that 104 unit on Marina Point. And I wasn't interested. I really didn't know about large multifamily at that time. And I was just like, oh, like I can't do that. Like I don't know how to raise capital or get into that. Like that must be for the rich, like of course, like it was outside of my comfort zone, and I just had the, very limiting beliefs there. And then I bought a quad. We ended up buying a triplex and raised some capital from that. And then, I had this thought, like, I wanted to keep going more and more, but I realized I couldn't use my own capital. And then we had the success with raising capital for this triplex. And it was just like, well, like, why don't we just go for large multifamily? Like, I'm spending the same amount of time and effort with these smaller multifamily properties, and I could just be doing the same thing with larger multifamily. So I went back to my mentor and was like, hey, like you're doing this, like, what programs are you part of? Like, do you have any books or recommendations? And he was a part of the Michael Blanc mastermind group. And he was actually like a mentor himself, like in the group. And so he gave me Michael Blanc's book to read. And so I read that book and I was like, damn, this is really cool. Like I was just like eating it all up on duty one day. And then from there, Michael Blanc had a number of like in-person meetups in Dallas, and he had one in DC, and I went to. And then from there, like I started looking into podcasts and YouTube videos, and like going to in-person events. And I went to like I think 3 or 4 in 2019 before I ended up going and moving to Japan. So that's how I ended up meeting people, just going to different in-person events, watching YouTube videos, reading a bunch of different books, like collecting books on multifamily. I realized that, I needed to start digging my investor pool, I guess, if you will, and raising capital that way if I was going to start doing my own deals. So I started doing that in 2019 as well. And basically talking to everybody I knew about multifamily and if they want to get in, made a sample deal package, and then yeah, kind of the rest is history. So that's how I got originally started.
Perfect. That's awesome. Thank you, Anthony, for sharing so much information. So does anybody else have a question? I think we cover
and there was a question in the chat. It asked for Anthony. So does that mean that it's crucial to have some of your own capital if you're starting with multifamily, or do you need to have your own capital, or can you use everyone else's money instead?
Yeah, great question. So on Marina Point, I didn't end up putting in my own capital personally. I didn't end up putting my own capital in. Of the general partners, though, there was like 10, I think we've ended up putting 10% in total. And there was 6 general partners, I think 6 or 7 general partners on that deal. So I ended up contributing by raising a bunch of capital for that personally. So that was my contribution, but I didn't end up putting in my own capital. Is it nice to have capital to put in? Yes. I wouldn't say that it's required to do so. Now, let me caveat that by saying, if you are going to be the lead sponsor on a deal, I would expect you to be putting in capital for this. If you are going to be kind of a tag along new investor to a general partner, and you're going to be maybe capital raising or doing kind of a small portion of the general partnership, maybe like being boots on the ground in a particular market, maybe doing a small portion of asset management, maybe helping raise, maybe for $1 million raise, you're doing 50,000 or 100,000. I think it's not necessarily required for you to bring your own capital to the table, right? Now, understand you're probably going to get a smaller portion of the general partnership equity for that. But I think if you're bringing other things to the table, I don't think it's necessarily needed that you bring your own capital. But as a whole, the general partnership will bring a portion of the capital to the table. Does that make sense? Did I answer that question?
I think I've got a couple more questions on that. So if I have like a friend of a friend who's putting together a project, could I jump in and offer myself as a capital raising general partner as kind of like the tag along investor then?
Yeah, absolutely.
And
that's a really great way to get started, actually. And it's a great way to get your foot in the door and get yourself going. I mean, that's how, like I said, that's how I got started. I don't think you need to raise 100. Sorry, go ahead.
And then what would that look like exactly for me? Like, I'm trying to remember what you talked about, like a sample packet or something, or that you talked about. Like, so what would that look like on my part for what I would do? Or like, if I have zero experience in capital raising, do I, can I learn it fast enough to viably offer myself as an asset?
Yeah. How much time until they close on this property?
They're planning to close in like March, so still a couple months.
Oh, you have plenty of time. Yeah.
Yeah.
So you can use the property itself if you want. You can just put up, a pitch deck for it itself. So I'm happy to send out the pitch deck for Marina Point. It's like 40 slides or something like that. And it goes into details on like what the investor information actually looks like what the returns are going to look like, what the business plan is, market information, things like that, right? So it's pretty detailed, and you can be as detailed as you want on it. And obviously there's like design details that go into it too.
Sure.
So you can actually put the actual package together for the deal itself, or you can have a sample deal for you. So what I did was I just took a property in a market that I was potentially interested in investing in, and I put that together with market information for that particular area. And I put sample returns that I would expect to get for that particular property in that particular market. And I threw a property manager on there that I was expecting to use. And I was like, and I pitched it to people and potential investors as, I don't have a deal yet, but I'm working with potential operators who would have deals like this. These are the types of returns I would be expecting. This is the potential market I'm looking into. Would this be something you'd be interested in, right? And then people have the options to look at it and be like, okay, they're making excuse me, potentially making 10% returns, it's tax-free cash flow. It's a market that I like or don't like, whatever else, right? Ultimately, you're kind of educating them on what they're going to be getting into, but they're really kind of trusting you and to invest their money with, right?
Yeah.
We can talk more offline if you want to get into that more, but my recommendation is you just build the pitch deck on the property that you're wanting to invest in, or
Okay.
have them in.
Thank you so
Cool.
much, Christian. We do have one more question, Anthony. It's Dario wants to know, can property manager be a part of the investors so they have incentive to do well?
Yeah, excuse me, absolutely. There's actually two of the properties I'm on. We have that as our property manager is actually the property manager president of the company is actually a general partner on the property as well. So they have an incentive for the business plan to go well because they're getting equity and they're getting cash flow from that property, right? So downside on that is if they don't do well and you have to fire them, now it's a lot harder to extricate yourself from that. But now they have an incentive to do well outside of the 3 to 5% that they're getting in property management fees, right? So yeah, that's absolutely a great way to get your property manager involved outside of a scant amount that they're going to be making in property management fees.
Perfect. I'm going to take one more question, guys, we have in the chat, and then we're going to get ready to wrap up the formal session. So last question is, what made you decide on a general partnership versus an S corporation or LLC?
So are you asking that as a general partnership versus like a general partnership and a limited partnership? So, okay, so let me clarify. The syndication itself is an LLC, and under that LLC, we have two classes of partners. We have Class A partners, which are the general partners, and we have Class B partners, which are the limited partners. So they are broken out as two different classes of partners, but it is still an LLC, to be clear. So it's not an S corp or a C corp or anything different. It's still an LLC in that particular state, right? The Class A members are typically they're listed as a management company, and then the management company is its own separate LLC entity as well. And under the LLC entity, the management entity is where the general partnership equity is then broken out. So if you have 6 or what's called 5 individual general partners, and I'm one of them, I may have 30% equity of the general partnership because I did capital raising, I did asset management, and I did, let's just leave it at those two. And then Anne may have 50% general partner equity because she's a key principal because she put all of her net worth of needed for the property, but she also did all the acquisition property part of it. And then we have Ari and Ritarsha and Wei have what's called what is it, like 10 or whatever the rest of it. They have evenly split out from the rest of it because they did a little bit of capital raising from there, right? So that management LLC is typically how you break out the rest of the general partner equity, right? So, but the base property LLC is where you have it broken out for all the individual capital partners or the limited partners, and then that management partnership is then broken out separately into its own LLC.
Perfect.
I think I answered that question.
Yeah, thank you so much, Anthony. This is great information. But we're gonna get ready, guys, to wrap up the formal part. But some of us are gonna stay a little longer, so feel free to hang out with us later if you have time. I'm going to go. Please, quickly, I'm going to mention these. Give us your feedback. We want to make sure you feel supported on your journey, and the only way we know that is if you give us your feedback. After you finish the session, you are going to be able to see a service that's going to populate automatically. Please complete it and let us know what was your biggest takeaway, what other things, topics you want us to have, and all that good information. So please do that. I'm going to turn it over to Anne now.
Yeah, so for those of you who are here, you kind of got a little treat too, in that you're getting the sneak peek of what's to come. So our community has really built up a lot of momentum in the last year, so much so that I've went back to the APDI leadership and said, hey, we actually need our own Facebook group, because right now the main group has over 70,000 members. And so when we have things that we want to ask or share, we tend to be such a small portion of that. So a lot of our stuff that we share ends up getting lost in the sauce. And also a lot of what they do is in their time zone, right? Versus our time zone here in the Asia Pacific region. And so I went to them and asked, and they have granted. So coming soon, you will see we will have a dedicated Facebook group for just our Asia Pacific region. And so if you like what you saw here and you want to continue the conversation, this is a good way for you to do that. So it actually is not, it's set up, but it's not live yet. But go ahead and go on there and join. And then in the next couple of weeks, we'll go live, and then we'll keep you guys connected. All right. And then again, what we do, we can't do what we do without our team. And so this shows you everyone across the board on Team Asia Pacific. The ones that are highlighted in red are areas that we have opportunities. So if any of you here want to really accelerate your path and your journey on real estate investing, and you have some time on your hands and you're willing to do some, kind of connecting, I would encourage you to consider if one of the areas is open to be a volunteer host. Even if you have zero experience, that's what I love about our team. I mean, we have people here who've never done a single event or even put together a party, and we've been able to kind of bring them into our fold, give them the tools and give them the support so that they can get something going. And so again, if you are in any one of these locations, or you know of someone in those locations, they're interested in real estate investing, and more importantly, they want to accelerate their path, I would tell you being a part of Team Asia Pacific in that way is definitely a great option. Back to you, Ari.
Yeah, well, thank you so much, guys. I'm gonna give our closing remarks here, and I'm gonna start with huge thank you, Anthony. Thank you so much for your time. Thank you for sharing your amazing knowledge with us. Oh my God, so much to learn and go, but truly appreciate you being here with us. I want to thank Ritarcha for her amazing marketing strategies and help us to put the all the information out there, and the APDI host for helping us spread the word as well. And to all of you guys for being here today. You 100% are better off because you show up and because you're here. Again, I hope that today's discussion has left you with fresh insight and new perspective to consider. Learning is a continued journey, guys. So don't let it stop here. Continue networking, continue connecting with other people, stay inspired and curious. I will leave you guys with that. Next, I wanted to share what we have coming up. And if you enjoy this meeting, our next meeting promised to be equally captivating. We want you to mark your calendars for October 21st. We are going to be talking about how to leverage tax planning in 2023. Right on that time that we all start thinking, oh my God, it's tax season again. So this is going to be a great topic. We are going to have our guest speaker is a CPA with a Master of Science in Taxation. So not only she's a CPA, but she went ahead and got a master in taxation. So it's going to be great. And so stay tuned for more information. So this will close the formal part of our event. I'm gonna stop recording now. Some of us are gonna stay here and hang out a little longer. So if you have any question that we didn't get to during our Q&A, feel free to join and ask now. So thank you again. Thank you so much.
All right, great job, Ari.
Yay! This is fun.
Yeah, so there were more questions. I know we didn't get to everything, so I'll go ahead and read off some of them that came up in the chat. Anthony, are you still okay with time to answer some of them?
Yeah, go for it.
Yeah, okay. So Wei actually asked had a question. Wei, did you want to share your question?